Hello and welcome back to our monthly Global FX Outlook series. I'm George Vesey, the lead FX and macro strategist here at Convera, and I'm joined by my colleague Antonio Ruggiero, our senior FX and macro strategist. And today we'll be walking you through our latest global currency outlook report for June, and that features the key themes and events that are shaping financial markets. We provide extended research on FX volatility analysis and our FX forecasts. And we take a scenario-based approach as usual to help safely navigate what can be a very unpredictable and at times highly volatile currency market. So relief, risk, and repeat. That's the name of the game at the moment with the continued erratic policy making from the Trump administration these days. We've seen a temporary breakthrough in the US-China trade talks that led to a 90-day mutual reduction in tariffs, and that sparked a surge in risk appetites. We saw global equities rebound, erasing those losses that we had that we saw endured after April's Liberation Day. The US dollar as well rebounded slightly from three-year lows. Some of that optimism was short-lived when President Trump announced a threat to impose a 50% tariff on EU imports by June the 1st. Later, that was postponed to July, but it just rekindled fears of renewed trade tensions. And then came the court ruling just recently that deemed Trump's tariffs are illegal, further fueling risk appetite as investors anticipated a rapid rollback of these tariffs that could ease pressure on the US and global growth outlook. But of course, the Trump administration is expected to appeal against this ruling. Therefore, policy uncertainty remains elevated, and a prolonged legal battle could put businesses off investment decisions, and that could put a dampener on the economic activity and outlook as well. But attention has also shifted to the US fiscal outlook that we'll touch on today. Tariff revenues offer some support on that front around deficits. But the recent tax cut bill, compounded by Moody's downgrade of US credit rating, have driven a surge in long-term Treasury yields, which has had implications across other financial markets as well. Higher yields are typically leading to a stronger currency, but the US dollar and US yields have decoupled over the last couple of months, and more evidence of fading confidence in US assets there. So as we can see, despite the circa 4% recovery from three-year lows that we saw the dollar stage, the rebound lost traction. This whole broader de-dollarization narrative just is eroding this longer-term confidence in the dollar. Meanwhile, the euro remains largely at the mercy of US sentiment. We did see the healthy correction from the three-year highs nearer the 116 level, but it seems that data-driven momentum is required for the euro to break back decisively above that 113 level, it seems. As for the pound, it rose to its highest level since February 2022 against the US dollar this month, just shy of 136. And that's been supported, of course, by the weaker US dollar, but also domestic factors, the stronger trade relations with both the US and the EU, the trade deal with India as well. Let's not forget UK economic resilience that we've seen with better than expected data, and also hawkish Bank of England policy, setting it apart from a lot of its G10 peers. And finally, down under, the Aussie dollar remains in a kind of sideways trading pattern, with Australia's improving terms of trade and China's yuan resilience enough at this stage to cushion that drag on the Aussie from the dovish Reserve Bank of Australia that we saw this month. So let's jump in to the main content of the report. So starting with the global economic outlook. So we're looking at the macro themes here and what the key themes are that are that we're keeping our eyes on, and what's driving volatility and these kind of trends that we're seeing in FX. But firstly, to reiterate, policy uncertainty is still at very elevated levels. Since President Trump's election win, global policy uncertainty has surged, and this is partly due to his unpredictable leadership style and the shift in political priorities. And as a result, investors continue to face this backdrop where a sudden policy change or a tweet from Trump causes increased volatility, and that seems to become the new normal. Uncertainty, of course, remains a key theme, and it's a sizable drag on our near-term outlook for the US economy and for the global economy. But there's one theme that I wanted to draw on today, and that was a slight silver lining, perhaps arguably, for the US economy, which is Trump's new tariff policy that has significantly increased revenues from import duties. So as of late May, the US collected some $70 billion from tariffs. That's a 76% increase compared to last year. But whether it can replace the income tax as a primary funding source remains uncertain at this stage. Federal income taxes totaled $2.4 trillion last year, highlighting tariff revenues are probably not going to be enough to offset the lost tax revenue. And we're also wary of the tariff front loading situation as well, i.e. US importers scrambling to buy as much as possible from abroad to avert the tariff impact. And this is likely another reason that contributed to the depreciation of the US dollar that we've seen over the last month or two. But anyway, observing these revenue trends over the coming months is going to provide a clearer picture of the policy's impact. Another key theme on the radar is related to the fiscal fears and the surge in global bond yields that we've seen. So we've seen a bond sell-off globally accelerating on the heels of the US Treasury's rout. And bond prices down obviously means that yields are rising. And one of the main causes of this is the unease with worsening fiscal trajectories driving this sell-off and causing particularly long-dated yields to surge higher. It's not just in the US either. Japan's 40-year yield hit a record high. The UK's 30-year yield near the highest since last century. And these soaring long-term bond yields have far-reaching implications across financial markets and the broader economy. One major issue is that most, though not all, countries are now heavily indebted relative to the past, and so they're already spending a great deal more money servicing their existing borrowing, and the UK is a prime example of this. What's interesting is the fact that central banks are leaning towards cutting interest rates. They're tilting towards that. In other words, dragging short-term borrowing costs down, but that's having little impact on long-term yields. So to put it into jargon, the yield curve is steepening in this quite unusual manner. So basically, investors want to get paid more the longer they own the debt. And one of the reasons is due to concerns about fiscal stability. And another is also because they're no longer, or there's no longer a belief that there's only one way for inflation to go downwards. So there's some concerns around inflation staying above target for longer as well. Now, as I mentioned at the start as well, typically higher yield should support a currency, but if driven by these fiscal concerns like we're seeing in the US, they can undermine confidence, and hence that's one of the other reasons why the dollar's depreciation that we've seen doesn't go in line with the rise in yields. We've seen a decoupling of the relationship there. A third theme that we want to touch on and relates to how economies are performing. And although consumer and business confidence remains subdued, survey data points to a softening amidst all of this elevated policy uncertainty and now also the stress in global bond markets. But really, a lot of the data from most major economies has actually surprised more positively than expected compared to what we saw at the start of the year, as we can see on this chart. So that's easing global growth slowdown fears or recession fears. The UK, as you can see on the left of the chart, really stands out here with its economic surprise index now at an almost one-year high. But that said, this data is likely being distorted by a run of tariff front loading. As I mentioned before, this is going to boost short-term activity, but it doesn't really indicate sustained economic strength. So therefore, it's important to keep a watch of the incoming hard data and also how this influences monetary policy as well. So in Europe, for example, the disinflationary trend remains intact and leading indicators pointed to slowing economic growth across the Eurozone. And that's forced more of a dovish repricing of the European Central Bank policy expectations, which is arguably capping the euro's upside as well. Now, the theme in focus, we're moving on to the next slide. We have talked a lot about tariffs over the last couple of months, rightly so. But as I mentioned, there's been another theme that's come to the fore, and that's the fiscal risk that's gained a bit more attention over the last couple of weeks. So the combination of Moody's US credit downgrade, but also the lackluster reception of a proposed tax cut bill that's going to add trillions of dollars to an already bulging budget gap. So that's raised concerns about debt sustainability, of course. Trump's budget bill is working its way through Senate at the moment, and there are concerns that these spending cuts are going to get whittled down and the stimulus is going to be added, and that's going to worsen the deficit outlook. Bear in mind, last year, the US deficit was 6% of GDP. It's projected to rise to nearly 9% by 2035. And as I mentioned on the previous slide, increased tariff revenues are going to go some way in offsetting this risk, of course, but rising deficits in a higher rate environment does raise questions about long-term sustainability. And as more clarity emerges around the fiscal policy, some of the uncertainty premium that's baked into long-term yields may start to fade, but at present, investors are increasingly wary about holding long-term debt, it seems, because of this spiraling debt and deficits. This isn't just another rate shift, it's more of a wake-up call. As we previously noted, yields aren't rising on growth optimism. They're responding to fears around the long-term credit worthiness, which is why term premium accounts for a large share of the move higher that we've seen in yields. And all of this adds to the structural challenges and the continued diversification away from dollar-denominated assets as well. So, the bottom line here is that the long-term fiscal outlook remains a concern at this stage, and another key structural headwind to the US dollar. And before we delve in more into the FX analysis, as you can see on the next slide, we have a jam-packed calendar of data releases as usual in June, but we've also got a heap of central bank decisions to navigate. The Fed, that's expected to keep rates unchanged at 4.5%, as is the Bank of England at 4.25%. But the probability of a rate cut by the European Central Bank on June the 5th is currently 97%, so that's baked into markets. Whilst the Swiss National Bank, there's a chance that they could cut by 50 basis points. So markets have about a 50% chance of that happening. So one to watch there. As a reminder, rate differentials are a key driver of FX trends. Granted, trade policy and politics, geopolitics and domestic politics have been a dominant driving force, more so of late, arguably. But dislocations between rate differentials and FX trends don't tend to last long. And that's why keeping a close eye on central bank guidance and interest rate expectations will be integral as an indicator for longer term FX trends. And with that, we'll move on to the second section of our presentation, the global currency outlook. I'll hand over to Antonio to walk us through some of the key trends and trading ranges that we've witnessed in major FX pairs, as well as where the spot price sits in relation to long-term averages. Antonio, what can you tell us?
Thanks, George. Right, so let's take a broad look at FX pairs this month, starting with our volatility analysis. So one key theme that we see here across the G10 currencies is that they've shared a bullish momentum fueled by that weakening confidence in US assets. Investors, in other words, have been encouraged to seek diversification, pushing up demand for alternative currencies, although to different degrees. In such a highly volatile environment, traditional safe haven currencies like the Swiss franc and the Japanese yen are going to outperform. As you can see from the chart, the top two pairs, USD JPY and USD CHF, the current spot sits around the bottom 10% of the high-low range, both on a 30-day and a 1-year basis. And both pairs actually trading lower, roughly 8% year to date. Now, while the euro has recently shown a more prominent safe haven status, what's interesting is that the US dollar, on the contrary, is now negatively correlated with the VIX, that volatility index. As VIX goes up, DXY actually comes down. Well, this suggests that the dollar is losing that safe haven appeal. amid this sort of broader sell America trade. Now, a bit more on the euro dollar. Euro dollar has certainly benefited the most out of this dollar weakness. It has a beta of 0.68, which suggests that for every unit increase in the DXY, or even better, decline, euro dollar actually rises by 0.68 units. Now, despite euro area's economic outlook still looking quite poor, as we saw also earlier in the month of May with some very disappointing PMIs, euro dollar is actually up 8.5% year to date, driven by that momentum from key US events, the erratic trade policies that we see in the so-called Big Beautiful Bill and Moody's downgrade of US debt. All of these factors contributing to casting a shadow over the future of the US economy, and the euro is benefiting from this. A similar story unfolds with USD CAD, which has largely benefited from that broad-based US weakness, while domestic fundamentals have kept deteriorating. The pair reached its lowest level in months at 1.368, following headlines around tariffs and tax bill that further undermine confidence in US assets. Now, while dollar weakness certainly played a role in explaining those price movements, GBP USD stands out as the pair where domestic factors have had the greater influence. In fact, unlike its G10 peers, sterling is a lower beta to declines in the dollar index, meaning it's actually less sensitive to dollar movements. This allowed the pair to rally to a 3-year high of 1.359. Sentiment around the pound has turned more optimistic, supported by UK trade deals, a successful summit with the European Union, resilient domestic data, and an overall more hawkish Bank of England. Slide. What we like to do here is to assess FX positioning relative to historical averages in order to highlight where potential opportunities may lie for our clients and stakeholders. Now, let's start with the pound US dollar. The pair has secured 4 consecutive months of gains, still holding above short and long-term moving averages, a clear signal that the uptrend momentum remains hold. Sterling is appreciated against more than 70% of the global peers year to date, underscoring its strength ultimately. Even against the popular euro, the pound euro pair is trading 1.5% higher month to date, with the 120 handle now within reach, ultimately largely supported by that widening rate differentials favoring the pound. For UK-based clients and stakeholders, what that really means is the current market scenario favors imports from the US, as a strong pound enhances purchasing power against the dollar. Eurodollar maintains upward momentum, yet it struggles to break above that 115 high that we saw in April. The relative strength index, which tracks the strength and velocity of price movements, recently dipped to below 50 from previous highs of 80, signaling some waning bullish momentum for the euro. However, we do not view this as a warning sign for now. Instead, we actually encourage euro importers to take advantage of that euro strength that we're seeing today against the USD while it persists. Now, as we turn our attention to USD CAD, the pair found some strong support at 1.37, halting last week's 5-session slide, which pushed it over 3% below its year-to-date moving average. This level aligns with a trend line dating back to June 2021, reinforcing medium-term uptrend support. The bounce back to 1.38 was driven by a mix of oversold conditions, US-Canada bond yield differentials favoring the USD, and overall dollar strength that we saw this week. Given that a break below 1.27 appears unlikely, this presents a good time to buy USD for CAD holders, particularly as deteriorating domestic fundamentals in Canada may contribute to the end of that pair's 3-month decline that we've seen. Now, as we look at the bottom of that table, unsurprisingly, we find US dollar, Japanese yen, as the yen continues to gain traction as a safe haven asset amid market volatility. The pair is now almost 5% below its year-to-date average, a potential cue for USD buyers and JPY sellers to consider taking action. Now, as we assess where key pairs stand today, it's just as equally important to just look ahead. I will now hand it over to George, who will introduce us to our FX forecast section.
Awesome. Thanks a lot, Antonio. So where does, like Antonio said, where does the future, what does the future hold? All of this volatility that we've seen, the trends that we've witnessed, what about the future? What we're expecting to unfold over the next month and for the remainder of the year? Well, as ever, we discourage trying to pinpoint exactly where exchange rates are going to go purely because of the inherent inaccuracy of trying to do so. So we do obviously lean in a certain direction, of course, but we advocate instead to be well informed about different scenarios and why or how they might unfold and how high or low exchange rates might go based on certain assumptions coming to fruition. So firstly, taking a look here at sterling against the US dollar, our central scenario, which is includes a one standard deviation above and below the baseline forecast. As you can see here, that's the grey area on this chart, shows a range of 129 to 135 over the next 9 months or so. So in layperson's terms, we see a 68% probability of the exchange rate falling within this range. Sterling, as Antonio mentioned, it remains sensitive to what's going on in the US and dollar demand, but it's also being underpinned by idiosyncratic sterling strength, driven by a combination of those supportive UK trade developments with the US, the improving relations with the EU, the trade deal with India being key examples here, resilient economic data that I mentioned earlier, and relatively hawkish Bank of England signals compared to other central bank peers. And that's all supporting the pound's yield appeal here. And hence we've seen, as a result of all this notable uptick in the baseline forecast from May to June, as you can see in the middle there. The upside risks relate largely to this continuation of the de-dollarization narrative, with the pound being amongst some of the more liquid alternatives in diversification strategies, but also if growth differentials continue to narrow with the US in favor of the UK. So the US economy slowing down more, the UK economy proving more resilient, adding to that fact that it might lead to less Bank of England rate cuts relative to the Fed, and therefore again boosting the pound's yield advantage versus the dollar in this case. So if all this aligns, then perhaps we could see a gradual climb back towards that 140 level. The pair's only been above that for 5% of the time since the UK voted to leave the EU back in 2016. So a crucial level to keep in mind to the top side there. The downside scenario, that relates to a renewed confidence crisis in UK policy, as government borrowing costs may continue to soar, and as we saw evidence of that earlier this year with the decoupling of the pound and higher UK gilt yields. Perhaps that kind of situation may arise if we see a continued stress in the bond market. The Bank of England could also be forced into cutting interest rates more than markets currently pricing in if the UK economy does slow down materially and fall into recession, hindered by escalating global trade war weighing on global economic growth. And of course, given its high beta to risk, the pound is vulnerable to bouts of risk aversion, whereby investors dump riskier assets in favour of safe havens. Whether or not the US dollar reclaims its status as a haven currency is questionable in this current climate, though. That's it from the sterling US dollar future scenarios perspective, but I'll hand back to Antonio now, who's going to provide some more insights into the other major currency pairs and potential scenarios to keep in mind. Back over to you, Antonio.
Thanks. Now, given the deteriorating US outlook, we've actually revised our euro dollar year-end baseline upward from 110 to 113. On the upper side, ending on 1.22, and on the lower side, ending on 1.04. Nonetheless, the key message here is While euro-dollar continues to benefit from capital outflows from the US in the short to medium term, the rally remains fundamentally fragile, with the euro still priced above its intrinsic value. For that upside scenario to materialize, we would need tariffs pushing up prices, weakening demand and dampening business investment for the US, overall weakening confidence in US assets, but also strong domestic economic fundamentals for Europe. On the downside, risks center around the Eurozone's broader economic struggles. Beyond US tariff-related concerns, the EU continues to grapple with structural productivity challenges, smaller capital markets, and lower debt issuance relative to the US. Factors that may weaken, ultimately, investor confidence in the euro, prompt diversification into other currencies and assets. The key takeaway here ultimately is that euro's recent strength is less a testament to European resilience and more a reflection of their US vulnerability. But let's turn our attention onto the US dollar, Canadian dollar forecast. Here, our baseline forecast is unchanged relative to the previous report, with a year end target of 1.40. In an upside scenario, the pair could climb to 1.551, while a downside scenario could actually see a retreat to 1.30. Now, we expect today 2 Fed rate cuts in the second half of the year, although hawkish sentiment certainly persists, with inflation risks being very high, as we saw in the FOMC minutes in late May. Now this will be supportive of the dollar for now. Meanwhile, tariff-related premia are largely priced in, meaning that trade tensions are unlikely to drive further downside in the near term. One potential dollar positive factor is the recent US trade court ruling that we've seen, which deemed the unilateral imposition of Liberation Day tariffs illegal. Now, this decision could further ease risk premium, allowing the dollar to reconnect with favorable interest rate differentials. However, a significant dollar advance looks quite unlikely, just given the ongoing concerns that we have around new sectoral tariffs, which are actually unaffected by the ruling, and uncertainty in the US Treasury market heading into the summer. On the downside, several risks could push USD CAD lower. Broad-based US dollar weakness may send the pair actually below 1.38, particularly if capital outflows accelerate. A more aggressive also Fed cut cycle, driven by deeper economic deterioration, could erode the US interest rate differential, which is ultimately going to weigh on the dollar. In Canada, a new prime minister initiating early CU's SMA negotiations with the US administration could reduce tariff uncertainty, providing additional support for CAD. Meanwhile, a shift in the Bank of Canada's focus from growth to inflation could bring an early end to rate cuts, reinforcing the case for a stronger Canadian dollar. Lastly, commodity market volatility, especially with regards to oil, could influence CAD, given Canada's reliance on energy exports. As we look onto the last forecast, the Aussie dollar, US dollar, we expect a baseline of 0.63 by year end, with an upside scenario reaching 0.69, while a downside scenario could see the pair drop to 0.59. Now, although the Reserve Bank of Australia, RBA, is likely to take a less dovish policy path compared to other central banks such as the ECB, the potential for Australian dollar upside remains limited. That just given the appeal of the higher yielding US rates. At the same time, trade uncertainty today will be a key drivers in rate decisions. And given how high it is at the moment, markets are currently pricing a 70% chance of an RBA rate cut at the July meeting. By nature, Aussie dollar is a risk-sensitive asset. That means that if trade uncertainty improves, creating a more risk-on environment, the Aussie dollar will benefit in the long run. However, in the medium term, the US dollar is likely to cap Aussie upside, as the DXY index is now in a relief rally mode, moving actually away from its traditional safe haven role. On the upside, strong Chinese demand will continue to support the Aussie dollar, given the two countries are key trading partners, especially if trade negotiations between China and the US progress favorably. And finally, further fiscal easing by the Australian government to boost growth prospects is also expected to provide additional support for the Australian dollar. I'll pass it now back to George to wrap things up.
Awesome. Thanks a lot, Antonio. Some quality insight there. And as a reminder, if you want any further details on currencies and their forecast scenarios, you can read our Global FX Outlook report on Convera's blog page, where you can also access the rest of our macro market research, including our bi-weekly podcasts to help keep you abreast of all the developments that are ongoing and the dynamics of the FX market. And if you're interested to learn more about our many solutions on offer, maybe you want more information on how you can protect against this currency volatility that we're witnessing, or perhaps we can help you diversify into alternative markets if your industry is exposed to supply chain risks. Or maybe you're interested in efficiency and security and want to talk to us about automated global payment solutions, compliance controls, or fraud prevention measures, for example. We've got a wealth of products and solutions related to both FX hedging and to payments. So please reach out to your point of contact at Convera to learn more about any of this. That's it from us today. Thank you, Antonio, for your insight, and thanks everyone for listening. Best of luck and see you next time.